Today I would like to discuss about 6 big lessons that made me a better investor that I got from a different book that I had the chance to read lately, and I hope it will help you to manage better during this troubled time on the market and to be a better investor for the future. I really believe that I could become a better investor thanks to those books that I've read. So I would like to share with you today some parts of those books that I think are very interesting, that are highlighted in those books, and that I'm always liking to remind myself to read them again and again. So the first one is second level thinking. It's from the book The Most Important Thing from Howard Mark. And here he will talk about the difference between the people who have the first level thinking and the second level thinking, which is extremely important, especially if you want to outperform the market and be a good investor. You cannot be a good investor on the long run if you keep on first level thinking. You need to go outside a bit of the box and to be able to develop second level thinking. So here what he said in his book: first level thinking is simplistic and superficial, and just about everyone can do it, a bad sign for anything involving an attempt at superiority. All the first level thinker needs an opinion about the future, as in the outlook for the company is favorable, meaning the stock will go up. So here, the first thing you need to understand is, if you catch yourself being all the time needing third-part advice or third-part input or anything like this before investing, maybe you're a bit too stick on first level thinking. I'm not saying that it's not good to see different vision, but the problem is if you start looking for, okay, what does this person think about this stock? Does he think in the same way than me? Okay, I can invest. If he doesn't think in the same way than me, I should not invest. This is problematic. You need to be able to think by yourself, and obviously on the market you will always have people having a different theory, thinking differently. And it's not because they are thinking differently that they are right all the time. You can be thinking differently, but still it can be a good opportunity. And the opposite is also true. Donc, really take care of not focusing too much on what people will say, especially on internet. Now that you have a lot of people doing analysis of video, analysis of company and so on, really try to focus on what you learn from the business. If you understand well the business, if you're able to understand the metrics, the number, and the things that are inside. The second level thinking is deep, complex, and convoluted. The second level thinkers takes a great many things into account. What is the range of likely future outcomes? Which outcome do I think will occur? What's the probability I'm right? What's the consensus think? How does my expectation differ from the consensus? How does the current price for the asset comfort with the consensus view of the future and with mine? Is the consensus psychology that incorporated in the price too bullish or bearish? What will happen to the asset price if the consensus turned out to be right, and what if I'm right? The difference in workload between first level and second level thinking is clearly massive, and the number of people capable of the latter is tiny compared to the number capable of the former. So really try to practice to be second level thinker. It's really important. It's not because today you're a first level thinker that you cannot tomorrow be a second level thinker, okay? So don't blame yourself for anything like this, but just try all the time to question this and to push yourself to be one. And it will not only help you in investing, it will probably help you in every aspect of your life, and probably as well in your career, as second level thinkers are more rare and they are really more valuable. So you may have bigger paychecks, a bigger rise, whatever, bigger chance to get a job if you enter into second level thinking easy, okay? So the second lesson will be still from Howard Marks. It's Don't Be a Fish. It's saying in The Most Important Thing. It's a book that I really recommend you if you didn't read it yet. It's really good. So for every person who gets a good buy in an inefficient market, someone else sells too cheap. One of the great sayings about poker is that in every game there is a fish. If you played for 45 minutes and haven't figured out who the fish is, then it's you. The same is certainly true of inefficient market investing. So here there is two teams, people thinking that markets are efficient and people thinking that markets are inefficient. In my opinion, it's more difficult than efficient or inefficient. I believe that markets are kind of efficient, but not 100% of the time. And the job of an investor is to be, during this 10% of the time inefficiency, to be able to seize opportunities, and here he will be able to create a good long-term performance. That's why second level thinking is important, and also that's why it's so difficult to be a great investor in the long run, because you need to be able to find those 10%, which is not all the time, and to find it for a long time with the less possible mistakes. And it's a bit the same in poker. In poker, when you play, you don't play every hand. You play only the hand that you feel that you have a good outcome possible, that you have good probabilities of winning. That's why there is a fish at the table, because you have some people that play hands a bit randomly or play hands every hand. So if you're able to see this person, so in the market, if you're able to see this 10% where the market is clearly wrong, you have good chance. But if you're not able to see those 10%, here you may be the fish, so you will pay the price for the people that will be able to outperform the market. But always keep in mind, don't be a fish for the financial markets. Here it's Stocks over Bonds. It's from Jeremy Siegel, Stock for the Long Run. Also a book that I recommend. It's more for beginners and to discover everything, but it's really a very good book with the essentials and all the basics about investing. Bull markets and bear markets lead to sensational story of incredible gains and devastating losses. Yet patient stock investors who can see past the scary headlines have always outperformed those who flee to bonds or other assets. Even such calamitous events as the great 1929 stock crash or the financial crisis of 2008 do not negate the superiority of stocks as long-term investments. Here is just to show that whatever happens, you will have some panics and you will be maybe tempted to change from your stock portfolio to a bond portfolio, something less volatile, something with fixed income, and something that you may think, okay, it's safer. But at the end of the day, even with the great financial crisis, even with huge market crash, on the long run, stocks are always performing better than bonds. And it's like this in almost every country. Okay, I really recommend you stock for the long run because you will discover a lot of study, and most of the studies show that stocks always outperform bonds, especially on the long run. In 1 year, 2 years, 3 years, okay, maybe bonds will be better. But on the long run, 5 years and more, stocks really outperform. So don't fool yourself, don't try to time the market. If you want to make money, stay on stocks for the long run. Stay on stocks like as long as you can. If you're very good with bonds, why not using them? Or if you really need to have some safety money, some money that you cannot afford having minus 20% on it, okay, why not having some bonds in your portfolio? But again, if you want to have a great performance, I think you need to be concentrated. If you want that, I don't know, let's say stocks change your life, stock really give you a lot of money and make you way richer, I think you need to have some concentration. You cannot afford being in an all-weather portfolio, like 25% bond, 25% gold, 25% stock, or whatever. I think you need to be concentrated in one thing, to be an expert in this thing, and then capitalize fully on it. Then we have the story of Standard Oil versus IBM, it's same stock for the long run from Jeremy Siegel. Why did Standard Oil beat IBM when it fell far short in every growth category? One simple reason: valuation. The price you pay for the earnings and dividend you receive. The price investors paid for IBM was just too high. So here to give a bit of context in the story, he did a comparison between the performance on the market from Standard Oil and IBM. I don't remember exactly when it was, if it was in the 60s, 70s, 80s, something around there. And IBM was a growth stock, okay, double-digit growth every year. It was a future. For everybody, IBM was like the future big company. And Standard Oil was a big company also, but a company which will probably decline a bit, which is probably already very big and will not really grow much more or grow very slowly. So you had a company with a slow growth and a company with a fast and high growth. But the difference is the valuation of the two stocks was totally different. You could buy IBM, I don't remember the numbers, but let's say for a P ratio of 10, and you could buy Standard Oil, for a P ratio of 10, and IBM for a P ratio of 40 or 50. So here it shows that yes, you had better return with Standard Oil because you paid only 10 times the profits, while for IBM we were paying 30, 40 times the profit. So valuation really matters. Of course, growth matters. I'm not saying growth doesn't matter, and it's not the goal of this book to say this. The thing is, growth matter, yes, but it depends what price you pay for this growth, because high growth is really uncertain, and you can see it now on the market. The market is valuating better the company with a slow growth, but we are sure that you will have slow growth, than company with a high growth potential, but you are not sure how high will be this growth. It's way more difficult to put a valuation on this than on a company that you know that every year it will grow 5%. And that was the case here. That's why on the long run, Standard Oil beat IBM. But it was also with the dividend. Standard Oil had a good dividend. Nowadays, I don't think this is totally different. I think the case is still true. So you really need to take care of valuation and to how the growth will evolve. Next one is about cycles. Okay, so the two last will still be from Howard Marks, but from a different book. If you want another video like this from other books that I've read, just let me know in the comment. I will do it again. The reason for the first videos that I have mostly Howard Marks and Jeremy Siegel is that the two I have on digital. So with the ability of doing this, the other one are like physical books, so I cannot, I need to write it down and so on. So it's a bit different. Cycle are inevitable. Every once in a while, up or down leg goes on for a long time and or to a great extreme, and people start to say this time is different. They cite the changes in geopolitics, institutions, technology, or behaviors that have rendered the old rules obsolete. They make investment decisions that extrapolate the recent trend, but then it usually turns out that the old rules do still apply and the cycle resumes. So I think it's very good for what's happening now. We have Donald Trump putting tariffs, we have Donald Trump doing this war everywhere, this tariffs war, this economic war. You have a lot of uncertainty, people saying we'll have a recession, some others say no. The truth is, we don't really know, and it's all about a cycle. Like, we will have a recession, it's inevitable, it's all in a cycle. You will have some period with very good economic growth, some period with recession. It's normal, everything like this happens. When you're human, you don't have a problem by knowing that, okay, maybe once a year or twice a year you will have a cold, you will have a flu. It's something kind of normal. You're not scared about this. You don't stop living because you know that you will have a flu, you know that you will have a cold. And yet, for stock market, for economy, people stop living. People start being crazy, thinking that, oh, we'll have a recession, we'll lose everything, and so on. It's all about cycle. That's why, again, second level thinking. There is what is happening and what you can get from what is happening. So, okay, if we have a recession, it will just show that it's a good time maybe to buy more, to invest massively, because during this recession time, it means that when the cycle of the recession is finished, you will have an upward cycle. And this upward cycle is where you have the most people that make a lot of money. They don't make money actually they make money during the upward cycle, but it's thanks to the fact that they invested during the downward cycle. So don't panic about downward cycle, just embrace it, because it's the moment when you can put your money and be good. When you have a flu, when you have a cold, generally it's your body saying, hey, I'm a bit too tired, it's time for you to rest. And when you finish with this flu, when you finish with this cold and you're back on foot, generally you have some very good time because you have more energy, because your body was able to relax and rest. The last one, and I will finish on it because I think it's very, very good for the moment, is about forecasters. From Kenneth Galbraith, we have two classes of forecasters, those who don't know and those who don't know they don't know. So again, you may have JP Morgan, Bank of America, Goldman Sachs, whatever, saying we'll have a recession, we have 40% translation, Trump tariff are destroying everything and so on. You may have all of this, the truth is nobody knows. It's been 2 years that a recession is supposed to arrive, and a year ago, it was supposed to be the year where the recession was here. We didn't see it. And during this year, the only thing we could hear is the American economy is great. The American economy has never been as great. We have a low unemployment rate and the inflation is getting slower and slower. So here we go. The recession was out of mouth since the beginning of 2025, while 2 years ago, it was almost sure we'll have one this year or the year before. So the thing can change really fast, and I will not be surprised that the forecaster forecasts something totally different in the next 6 months or in the next year, and even maybe in weeks, they will have a totally different talk. They will say totally different things. So don't put yourself on it. Okay, you also have Warren Buffett who say a lot, don't listen to economy, geopolitics or whatever. Invest because you think the company is great, because you think the company have a great future, and you think that the company is cheap. That's the only thing that should make you buy this, okay? So if you like this type of video, let me know in the comments. It will be a pleasure to do something like this again with some other books that I will read, and or even other highlights that I did in the books that I could read.